Peter Lynch is one of the most legendary investors in history. So today we'll look at his 25 golden rules for investing and let's see what we can learn from him. But before that, some fun facts about Peter Lynch that you might not know. So who is Peter Lynch? He's actually the author of this book called One Up on Wall Street, which is a very popular and good book for beginner stock investors. And he actually also generated a 29.2% annualized return when he was working at Fidelity Magellan Fund. So to give you a gauge about how great this is actually more than twice of what the S&P 500 has earned during the same time period. So there's so much, we can learn from Peter Lynch and, learn about his investing success. So today we'll dive into his 25 golden rules. So rule number 1, investing is fun and exciting, but dangerous if you don't do any work. So here, Peter Lynch highlights the importance of doing our own due diligence and researching about the companies before we invest because, while as much as investing it can be very thrilling to, watch your wealth, your money grow up over time, but it can be dangerous if you don't know what you're doing and if you don't prepare. Rule number 2, your investor's edge is not something you get from Wall Street experts. It's something you already have. You can outperform the experts if you use your edge by investing in companies or industries you already understand. So here, Peter Lynch is actually talking about investing within your circle of competence. So your circle of competence is an area of expertise that you have for a specific industry or specific company. So for example, you might have a better understanding of e-commerce businesses because you perhaps work in an e-commerce company or you are an avid consumer yourself, so you know, how an e-commerce business generates money, what are the costs involved, and how do you measure the addressable market, and so on. So as you invest, along your investing journey, you will also find out that this circle of competence that you have can be grown and can be developed over time. So your circle of competence isn't something that is static. And it will actually grow. It can actually grow over time as you accumulate more knowledge and experience about different companies and different industries. And I guess the key takeaway here is that, it's not something that you'll get. Your advantage isn't something that you can get because, you're working in Wall Street, but rather it's something that innately yourself, you already have and you can develop. Okay, so rule number 3, over the past 3 decades, the stock market has come to be dominated by a herd of professional investors. Contrary to popular belief, this makes it easier for the amateur investor. You can beat the market by ignoring the herd. So here, Peter Lynch is saying that, there's a herd mentality that's very common, for us to think in terms of average, what the crowd is thinking, or to follow the wisdom of the crowd, so-called. But however, if we were to follow the median, the crowd, we will get average returns because the crowd is merely, to be a great investor, you can't think the same as everyone. You have to have a differing opinion from the average and the masses. And that is how you can generate good returns for yourself. Okay, so rule number 4. Behind every stock is a company. Find out what it's doing. So this is really similar to what Warren Buffett would calls it a business ownership mindset. So when you invest in a company, you have to think about it as a CEO. You have to think about underlying this stock. It's not a piece of paper, it's not a stock ticker, but it's a true business and a true company. So being able to find out what it's doing is essential to be a good investor. Okay, so now rule number 5. Often there is no correlation between the success of a company's operations and the success of its stock over a few months or even a few years. In the long term, there is 100% correlation between the success of the company and the success of its stock. This disparity is a key to making money. It pays to be patient and to own successful companies. So right here, it's quite clear that, Peter Lynch is saying that the returns that we get in the stock market doesn't come overnight, not in a few months or perhaps even a few years. But in the long run, the value of a company will eventually be reflected by the price of the stock. And, it pays to be patient and to wait out in the long run, and of course to own successful companies. Rule number 6, you have to know what you own and why you own it. This baby is a cinch to go up doesn't count. So right here, Peter Lynch is saying, we shouldn't invest in a company because based on our own intuition, we think that, okay, this company is good, like Alibaba is a great company or Facebook is a great company. But rather, we have to know why this company is so good. Why is it so powerful? So you have to look at some of their financial metrics. Why is this company better than its competitors? And as well as we have to look at the future cash flow of this company to see whether this company is trading at a discount to its intrinsic value. So having this knowledge about why you own a stock is really helpful, especially when the market is crashing or when the market is undergoing a bear market, because knowing what you own can give you the conviction to hold through during the tough times. Rule number 7, long shots almost always miss the mark. So here Peter Lynch is actually referencing to how we should avoid stocks that have relatively unfavorable fundamentals or even a weak outlook, even if they are cheap. Okay, because the price of a stock doesn't mean that it is equivalent to the value of the stock. So even if they may appear cheap, they may appear to be like cigar butts, but sometimes these unfavorable outlook and unfavorable fundamentals of this company, there's a reason why the stock is trading at a cheap discount. Yeah, so just be careful of these stocks. Rule number 8, owning stocks is like having children. Don't get involved with more than you can handle. The part-time stock picker probably has time to follow 8 to 12 companies and to buy and sell shares as conditions warrant. There don't have to be more than 5 companies in the portfolio at any one time. So this rule helps us to answer the question of how many stocks should I own in my portfolio. And of course, while this is very much a personal choice, I guess Peter Lynch is trying to hint to us that, don't get too involved with too many stocks and too many companies, because firstly, we might not have the time and the energy to analyze so many companies, like 50 over companies. And, it doesn't mean that, owning more stocks does not mean that you can get more returns. And later on, in one of the rules, we'll also talk about diversification and how diversification isn't just about owning more stocks. Okay, rule number 9, if you can't find any companies that you think are attractive, put your money in the bank until you discover some. Okay, this is quite a self-explanatory explanation. And rule number 10, never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. Always look at the balance sheet to see if a company is solvent before you risk your money in it. So buying companies with a strong balance sheet, this is very, very important, and it's one of the metrics that you should look at before you invest what your money into. And there are some metrics that you can look at, such as debt to equity ratio, interest coverage ratio, to find out whether this company is solvent and is able to repay its debt. So what is the benefit of having of investing in a company with a strong balance sheet? So one of it is that it provides a lot of room for the company when it expands into different countries or in different types of ventures that the company would like to go into, as well as a strong balance sheet can help the company to go through periods of trouble, periods of trouble in the market or in the industry. And I guess an example that we can show here is, for example, the case of Flux in Singapore. This company actually had really poor balance sheet and really a lot of debt. But however, investors were not aware of this because they were merely looking at surface level analysis, and they weren't really diving deep into the balance sheet. But if you were just to look at the balance sheet, you would, for one, almost immediately tell that this company is not able to repay their debt. So I say that this is one of the most important first filter that you should look at when you analyze a company's financials. Rule number 11, avoid hot stocks in hot industries. Great companies in cold, non-growth industries are consistent big winners. Okay, this is talking about, we should avoid popular stocks in popular industries. And, I guess one obvious reason is that if everyone thinks that this stock is popular, this stock is hot, then they would have been invested in this, and that doesn't necessarily give you an edge. If this stock is already so popular, it will be overly valued and inflated. Next, rule number 12. With small companies, you're better off to wait until they turn a profit before you invest. Okay, so I guess this rule is something that not everyone might agree with, because those who invest in small cap stocks would think otherwise. However, this is, Peter Lynch's style of investing, which is that he prefers to own companies that are already profitable. Okay, rule number 13. If you are thinking of investing in a troubled industry, buy the companies with staying power. Also, wait for the industry to show signs of revival. Buggy whips and radio tubes were troubled industries that never came back. So here he's saying that, as much as we are thinking about investing in different types of companies that may be innovative and so on, but we have to look at the industry, because the industry is equally, if not more important than, the types of companies that we invest in. So if you are, thinking about investing in a company, you have to look at what industry is this company in. Is it in a sunset or sunrise industry? And if you want to learn more about, the types of industries and how different types of industries have different potential, you can read Michael Mauboussin's paper titled Measuring the Moat. Rule number 14. If you invest $1,000 in a stock, all you can lose is $1,000, but you stand to gain $10,000 or even $50,000 over time if you are patient. The average person can concentrate on a few good companies, while the fund manager is forced to diversify. By owning too many stocks, you lose this advantage of concentration. It only takes a handful of big winners to make a lifetime of investing worthwhile. So this is one of the quotes that I really like out of his 25 quotes. So, right here he talks about not owning too many companies. And I guess this really reminds me of the 80-20 rule, or the Pareto principle, which says that 20% of your stocks actually generate 80% of your returns. So you should just focus on the 20%, owning a few good quality stocks that would really be of course, all the stocks in your portfolio should be good. However, if you were to just focus on the 20%, focus all and place all your big bets into these 20%, then these 20% will be your winners that will be able to ride you through the times of crisis and be able to generate the most returns for you. So it's not about owning so many stocks, it's not about the number of stocks, but rather how you concentrate on the few good winning investments. Okay, so rule number 15. In every industry and every region of the country, the observant amateur can find great growth companies long before the professionals have discovered them. So this point, is talking about how even as an amateur, even if you're not like the Wall Street analyst or professional, you are able to identify good growth companies because you are observant, and you might even have the ability to look at things from a different perspective as compared to the professionals. Rule number 16. A stock market decline is as routine as a January blizzard in Colorado. If you're prepared, it can't hurt you. A decline is a great opportunity to pick up the bargains left behind by investors who are fleeing the storm in panic. So here, Peter Lynch is talking about how the stock market is actually, the stock market decline is really normal, it's very routine, almost like a January blizzard in Colorado. And this kind of reminds me of Warren Buffett's quote about the stock market he says that the stock market is a device for investors who a stock market is a device for transferring money from the impatient to the patient. And what does it really mean to be prepared for a crash? To be prepared, it means to have a watch list of stocks that you want to invest in, and also having the bullets, having the cash prepared in order to really throw in your money during the periods of great bargains. Rule number 17. Everyone has the brain power to make money in stocks. Not everyone has the stomach. If you are susceptible to selling everything in a panic, you ought to avoid stocks and stock mutual funds altogether. So here, this is a reminder of Peter Lynch, one of his most famous quote, which is that the most important organ in investing is not the brain, but it's the stomach. So, having the ability to make money in the stock market isn't so much about your IQ, but rather whether you have the ability to stomach volatility in the market. Next, rule number 18. There's always something to be worried about. There's always something to worry about. Avoid weekend thinking and ignore the latest dire predictions of the new newscasters. Sell a stock because the company's fundamentals deteriorate, not because the sky is falling. So over here, Peter Lynch says that, it's very simple. Avoid news, avoid reading news, because the newscasters and the macro forecasters will fill your ear but never fill your wallet. And it also highlights, the importance of knowing when to sell a stock. He says that you should sell a stock not because the sky is falling, the economy is crashing, but if you found out that the company's fundamentals are going down, they are not really doing well, then that should be your deciding factor whether or not to let go of this investment. Rule number 19. Nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you have invested. So here again, he reminds us that we shouldn't pay too much attention to macro factors like interest rates and inflation. And Warren Buffett also said that if the Fed were to whisper to him in his ear what the interest rate would be for the next year, it wouldn't have made a difference to his investing style or what he would have invested in. Rule number 20. If you study 10 companies, you will find one for which the story is better than expected. If you study 50, you will find 5. There are always pleasant surprises to be found in the stock market, companies whose achievements are being overlooked on Wall Street. So Peter Lynch is actually a so-called story investor. So what this means is that whenever he invests in a stock, the stock selection process is actually based on a grounded expectation about the firm's growth prospects. So this expectation is really based on a story of what the company is going to do, or what is going to happen to bring about the desired results for the company. And in his book, One Up on Wall Street, he actually discussed the 6 different categories of stocks. So they are the slow growers, fast growers, stalwarts, cyclicals, turnarounds, as well as asset opportunities. And he says that, we should find companies that have good stories, and we must look at a lot of them, because based on the law of large numbers, then we are more likely to be able to find a stock whose success is being underestimated by Wall Street. Next, rule number 21. If you don't study any companies, you have the same success buying stocks as you do in a poker game if you bet without looking at your cards. So here he's saying that, investing is like gambling. Sometimes people say that, investing is not gambling, right? But investing is like gambling, essentially if you don't put in the effort to study and understand the companies that you buy. Rule number 22. Time is on your side when you own shares of superior companies. You can afford to be patient. If you missed Walmart in the first 5 years, it was a great stock to own in the next 5 years. Time is against you when you own options. Okay, so right here, Peter Lynch is talking about the differences between owning a stock as well as owning options. So when he says that time is against you when you own options, what he means is that the time decay in options. So this concept is basically telling us that the value of the option price will decrease over time. However, of course, there are strategies to mitigate this. But he is essentially highlighting the differences compared to if you own stocks. Time is on your side because the company that you own, if you really own shares of great companies, such as in this case Walmart, it will still prove to be a great company in the years to come, as even if time goes on, this company will actually favor you and the company as well, because the company will grow and continue to do well over time, and your returns will continue to grow over time. Rule number 23. If you have the stomach for stocks, but neither the time nor the inclination to do the homework, invest in equity mutual funds. Here is a good idea to diversify. Okay, so here he also talks about the diversification. Okay, so he says here, you should own a few different kinds of funds with managers who pursue different styles of investing. Growth, small value companies, large companies, etc. Investing the 6 of different kind of fund is not diversification. So, okay, he says it here, diversification is not a numbers game. It's not about investing in 6 funds, but rather, it's not about investing in a numbers of funds, but rather it's the types of companies that these funds invest in. So his point here is to invest in companies that have negative correlation to one another as much as possible. So when one company is going down, the other company's performance might be going up. And this can be due to the different industries that this company are in and how they actually react. They react differently to different macro factors. For example, when the interest rate is going up or interest rate is going down, it doesn't mean that your portfolio will move in the same direction. Rule number 24. Among the major stock markets of the world, the US market ranks 8th in the total return over the past decade. You can take advantage of the faster growing economies by investing some portion of your assets in an overseas fund with a good record. So right here, he's also talking about diversification across geographies, across different markets such as emerging markets, Southeast Asia, with huge growth opportunities. Okay, so now moving on to the last rule, rule number 25. In the long run, a portfolio of well-chosen stocks and/or equity mutual funds will always outperform a portfolio of bonds or a money market account. In the long run, a portfolio of poorly chosen stocks won't outperform the money left under the mattress. Okay, so Peter Lynch is saying 2 things here. So firstly, in the long run, if you buy stocks or equity mutual funds, you will outperform bonds, or if you were to invest in MMA, money market account, which is like a type of deposit account, but it's a savings account that usually require higher minimum balance compared to a typical savings deposit account. Okay, and secondly, he's saying that poor companies, if you buy poorly chosen stocks, these companies will not help you to beat inflation, which is the money left under the mattress. So it's important that we invest in companies that are well chosen, that are properly selected. And this is really important because if you don't, you might as well just keep the money under your mattress, and this doesn't help you to beat inflation. So that's it. Those are all the 25 golden rules that Peter Lynch has for investing, and hope you found this video and this content helpful. I'll see you in the next one. Bye!